Options trading is already complex, but when you're working with a small account, it only adds to those complexities. So in today's video, I want to show you how I would navigate the options market if I was working with a small trading account. Now let's first address why is it so difficult to trade options when you have a small account. It really comes down to basic math, because when you're working with a small trading account, each trade that you're making is going to be risking a relatively large percentage of the total account value. Let's say you have a trading account that's $2,500 in value and you risk $500 on a single trade. You're going to find that you're going to be risking roughly 20% of your total account on a single trade. So if you lose 3 or 4 trades in a row, you've effectively wiped out the vast majority of the capital in your account, and it leaves you with almost nothing left to continue trading. And in addition to this, when you're looking for opportunities that risk a relatively small percentage of your portfolio, it's becoming increasingly difficult in this environment to find stocks that are relatively reasonably priced. Many of the stocks that you like Facebook or Apple and Amazon, trade at multiples of 200, 300. Unfortunately, with many investors that I see working with trading accounts under $5,000, this is exactly why they resort to using strategies like YOLOing, where they buy really far out of the money call options, hoping to turn a small trading account into a relatively large trading account in a very short amount of time. Unfortunately, this is a terrible long-term strategy. It might work out for you a couple of times, but the vast majority of times those out of the money call options will expire worthless and you will lose 100% of the premium that you pay. So in this video today, what I want to present to you is an alternative method as to how you can grow a small trading account in a more sustainable way. To help you start off, there are 2 things that you need to do to set up a trading account first. 1, you need to set up a brokerage account with an options trading privilege that allows you to trade spreads, at least a level 3 clearance on options. The second is setting up a margin account, which requires you to have at least $2,000 in capital for the trading account. If you're not sure how to do this, I'll include some links below to brokerage firms that will help you set up these trading accounts. Now that you've set up your brokerage account, let's talk about the actual strategy you're going to need in order to grow your small options account. When it comes to options, there are literally hundreds of strategies that you can choose from. But when you're working with a small trading account, I recommend that you stick to one single strategy on one type of product in order to help you slowly grow your trading account in a sustainable way. And that strategy is to sell credit spreads on specifically index options, such as on the NASDAQ 100 index. Now, the reason I'm telling you to stick to one strategy on one type of product is because learning how to trade options may sometimes feel like you're drinking from a fire hose. So the goal when you're trying to start out is to minimize the number of variables that you need to learn. So when you're trading credit spreads, what you're controlling is risk and reward. You know exactly how much you can potentially win or lose. And also by trading index options, you're reducing your total amount of risk that you're taking on these types of products. And I'll explain what those mean in a second. So let's talk about the 3 key reasons why I suggest for beginners to start with a credit spread. First, it's because it's a limited risk strategy. It's very important for beginners to know exactly how much you're making or losing so that you understand your risk and rewards. The second reason is because it's a forgiving strategy. You can have the directional view right and be profitable. If the stock doesn't move very much, you'll still be profitable. Only if you absolutely get the directional view wrong do you have a loss on the trade. And third, because it's a very forgiving strategy. It's a strategy that by default, you can expect to be profitable more than 50% of your trades. I think it's important for traders when they're starting out to have trades where they're winning more than 50% of the time to build your confidence in your strategy and your confidence in the markets. Now, there are 4 reasons why I suggest investors who are selling credit spreads on a small account to do it on index options specifically. First, it comes down to liquidity. Index options are some of the most liquid products you can trade. When you're starting out with options, you don't want to add liquidity as another thing that you really have to be concerned about. The ability to get in and out of a trade whenever you need very quickly is something that you want to be able to have access to when you're first starting out. The second reason is European cash settlement. This is unique just to index options. The cash settlement process really allows investors to remove two immediate risks that you have when you're trading credit spreads, and that's assignment risk and exercise risk. When you're trading European cash settled index options, you remove these risks entirely. When you start trading stocks and ETF options, you can learn more about this and learn more of how to manage those risks. But when you're starting out, remove them entirely by trading index options, such as on the NASDAQ 100 index. Thirdly, you have a tax benefit. When you trade an index option, they're taxed at 60% long-term capital gains and 40% short-term capital gains. That's going to provide you with a tax advantage when you're trading index options versus stock and ETF options. And lastly, no earnings surprises. When you're trading index options, index diversify away earnings risk. So this is something you don't have to worry about when you're trading credit spreads on an index option. Eliminating the earnings risk is just one more step in making your learning process a little smoother for a small trading account. Now, the only challenge with index options is that typically they are very, very large size, which means that for many retail investors, especially ones starting out with a small trading account, they are simply too large for retail traders. However, with the launch of the new XND index option product, this is specifically suited for this very purpose. The new Micro XND product is 1/100th of the full value NASDAQ 100 index and currently has a notional value of only about $14,000 per contract versus $1.4 million for the full value index. So I think the best way to learn this is to go through a real trading example. Let's first take a look at XND, which is currently trading around $140. The trade I'm going to show you is a credit spread, and I'm going to put a link below for you to learn more specifically about the benefits and advantages of trading credit spreads. The trade example I'm going to show you is based on XND trading currently at around $140. What we're going to do is we're going to sell a 45-day at the money put option, so around $140 strike price, and then buy back a 45-day $135 put option, an out of the money put option. And let's say on this particular trade, the net credit that we receive is $200 for the trade. Now, with a credit spread like this, where the distance between the two strikes are $5 apart, and we're collecting $2 of that $5, that means we're risking a total of $3 per share. So on this entire trade, your maximum gain is $200. That's the most you can gain on this trade. Your maximum risk is $300. That's the most you can lose. So let's take a look at the potential outcomes of XND and when you'll see a gain and when you'll see a loss. So for this, we're going to explore three potential outcomes. Where XND rallies above $140, you're going to gain the $200. And if XND doesn't move anywhere, stays around this $140 at expiration, you're also going to gain those $200. Only when we get the directional view wrong and the stock declines substantially below that $135 strike price that we've bought, do you receive a maximum loss of $300. So this is a strategy that's suitable when you have a bullish view on XND. As you can see from these examples, it's a forgiving strategy. And if you're new to credit spreads, I've linked a deeper dive below so that you can learn more about trading credit spreads and the best practices for them. And most importantly, by starting out with credit spreads on an index option such as the NASDAQ 100 index, what you're going to be able to do is remove a lot of the complexities and risks that comes with trading options in a way that's more defined and allows you to build confidence in your strategies in a more consistent manner. I hope that this video was useful in helping you get started with a small trading account. And I'd love to hear from you, so please leave some comments below and let me know what your experience has been in starting options trading with a small account. And if you found this video useful, Don't forget to hit subscribe and remember the notification bell so that we can send you an alert the next time we upload a new video on this series. Thank you and have a great trading day.